Hi, I'm Carlos. I'm here to introduce the team members and the companies for this ratio analysis presentation. Taylor will talk about profitability ratio, Katie to discuss the liquidity ratio, Chal will share more information about the solvency ratio, and Ismail to tell us more about the market ratio. So why Lufthansa Group? The aviation industry is one of the most affected sectors during the recent crisis. Our group aims to gain insights into the general trend of ratios and how the airline industry can use them in their decision-making process. We have focused on Lufthansa Group as a main company, given its worldwide operations and diverse business segments from passenger traffic, logistics, catering, and maintenance. Another interesting fact about Lufthansa is its innovation hub that focuses on simplifying user experience. Two other airlines selected for this exercise are United Airlines for having a similar group holding structure, operations, and business size. On the other hand, we have selected Air Canada with a more streamlined operations and focus on its core business in North America. Over to you, Taylor.
Thanks, Carlos. Net profit margin compares a firm's net income over net revenue. Utilizing income state data, net profit margin helps us answer the question, how strong is a firm's overall financial health? The COVID-19 pandemic caused revenues to crater as firms attempted to control expenses and limit financial impacts. The net profit margin will spotlight financial successes and failures as airlines with traditionally tight profit margins attempt to stabilize financial performance at 2019 levels in 2020 and 2021. First, we'll examine how turbulent revenues played their part in the net profit margin. Airline revenues, the ratio's denominator, is traditionally reported in three buckets: passenger, cargo, and other. All three airlines saw significant revenue reductions from 2019 to 2020 as passengers dropped off. Even Lufthansa, whose more diverse profile relied only 70.9% on passenger revenue in 2019. Essentially, passengers are the backbone of an airline's revenue stream, and when profitability is heavily reliant on them. Revenue impacts from ridership, shown via passenger load factor, demonstrate how many seats on a flight are revenue generating. The decreased load factor shows airlines continue to operate flights with decreased ridership, adding reduced revenue at increased cost. Operating costs associated with airlines are traditionally very high, especially fuel, wages, depreciation, and amortization, which contribute on average 60% of an airline's operating expenses. Lufthansa demonstrated the worst operating expense cost control in 2020 and 2021. And even though they saw a $2.2 billion tax break in 2020, this lack of cost control drove the greatest year-over-year drop in net income of all companies reviewed. While all airlines saw significant decreases in net incomes resulting from the high operating costs and low revenue, United rapidly stemmed the bleeding, which contributed to improved recovery in 2021. Decreases in net income resulted in decreases to profit margin. Overall, we saw the entire industry's net profit margin drop off from 2019 to 2020 and start to recover in 2021. Lufthansa's year-over-year net profit margin declined 706% from 2019 to 2020, the worst and worse than industry benchmark. While it showed slight recovery in 2021, it was only slightly better than the industry average. On the other hand, United Airlines had an industry average decline in 2020, but the strongest recovery in 2021. This performance demonstrates that Lufthansa's mediocre net profit margin performance could have been improved by better operating expense control, even with reduced ridership. Now I'll pass you along to Katie for liquidity.
Thanks, Taylor. So I'm going to speak about the quick ratio, which is a liquidity ratio, and it only includes quick assets or liquid assets in its calculation. It's also known as the acid test or acid ratio, and the formula is current assets minus inventory divided by current liabilities. The ratio is considered one of the most conservative liquidity ratios because the quick ratio only considers assets that can be quickly converted to cash within 90 days or less. One, or a ratio of 1, is considered to be a good quick ratio because it means that for every dollar of current liabilities, you have $1 of current assets that you could liquidate quickly to instantly pay off those liabilities. In looking at the industry standards pre-pandemic, we see that the airline industry generally has a low or below 1 quick ratio, that most airline companies could not pay off their current liabilities within 90 days if or as needed. Throughout the pandemic, all three airlines improved their quick ratios, with both United and Air Canada increasing significantly to ratios above 1. And even though Lufthansa's quick ratio has improved significantly, it's still lower than their competitors, sitting below 1 in 2021, which keeps them in a vulnerable space. In the 2021 Lufthansa annual report, the Lufthansa Group makes a commitment to maintain financial stability to protect against future crisis. They commit to permanently holding liquidity between 6 billion and 8 billion euros, which represents a significant increase compared to pre-crisis levels. On the next slide, I have a section of the Lufthansa's balance sheet to showcase where the most significant increases were. And we see this actually on all three companies' balance sheets, that the biggest and most significant increase is in the current assets. It's more specifically in cash equivalents and securities, while the current liabilities stayed quite stable throughout the 3 years. So this is where we're seeing that big increase. You'll also see that the inventory goes down throughout the pandemic, which could signal that Lufthansa was selling off inventory to increase liquidity and cash on hand. Some of the potential reasons for liquidity improvements could be selling off old aircrafts and inventory, streamlining fleets and reducing costs and streamlining processes, so maintenance and staffing. Also, the economic stabilization grants and subsidies from respective governments, including things like government bonds, and approval from boards to increase the number of shares sold in order to increase equity. Overall, the pandemic showed the deep vulnerability of the airline industry and created space for these airlines to explore these vulnerabilities further. It may look as though they're all improving their liquidity, but I wonder how they can maintain, or if they can maintain, the higher ratios as government assistance reduces and things start to go back to business as usual. I'll pass it over to Chad for a look at solvency.
Thanks, Katie. So when we're looking at solvency, we're looking at the long-term health and viability of a company, or more importantly, how equipped they are to handle repayment of long-term obligations and debt. Within the debt ratio, we're specifically looking at how much of a company's assets are financed through debt. A large ratio tells us that a larger proportion of the assets are financed or leveraged through this debt. Leverage is a very important factor, as it shows how averse a company may or may not be in terms of using board capital to fund assets and revenue producing aspects of their business. This works only if their ROI is greater than the obligations required to the creditors. For this ratio, we're going to be using total liabilities, excluding shareholder equity divided by total assets. This will be expressed as a fraction or a percentage. This ratio has told us that the airline industry is heavily propped up and financed through debt. Another interesting thing this ratio has shown us is the way in which the airline industry chooses to report and represent this ratio, as opposed to debt being, or assets being acquired through debt. They're representing this through the amount of equity used to finance acquisitions. So this graph illustrates a similar trend across the board for each company. The airlines relied heavily on debts and government loans to maintain operating costs, and demand through the global market took a massive reduction during the pandemic. Coming out of the pandemic, we can see these companies have begun to trend back upwards. And compared to the competitors we have analyzed, we can see that Lufthansa uses a larger proportion of their internal equity than do their competitors. Lufthansa has made strides to improve their current debt ratio and is trending in a positive direction. Moving through the 2020 statement, it was noted that a massive increase in government funding negatively affected and magnified this declining ratio. Overall, we can see the airline industry represents their view of debt ratio slightly different. They focus more on the percentage of equity to finance assets and acquisitions. From the data reviewed, we can see that Lufthansa does a better job allocating this equity than do their North American competitors, and are trending to increase this percentage as a whole. We can assume that the long-term health and projection of Lufthansa is in good standing, especially compared with companies such as Air Canada, who are almost entirely leveraged on borrowed money. Over to you, Ishmael, for the market ratio.
Thank you, Chad. The price to earning ratio is the ratio of the market price per share to annual earnings per share. A low but positive PE ratio means that the company is generating high earnings compared to its current valuation and might be undervalued, while a high negative PE ratio shows that the company is generating heavy losses. A PE ratio of between 10 and 17 is traditionally considered to be a fair trade. However, PE ratio is not particularly relevant as a standalone number, but it is useful to compare it with a certain benchmark. Good benchmark here are the PE ratio of another company in the same industry, the PE ratio of the entire market, or the PE ratio of the same company at a different point in time. The earnings per share has the most influence on PE ratios. The price per share is very volatile. At the height of the pandemic in 2020, Lufthansa share price dropped from 16 euro to 7 euro within 3 months. On the next slide, we looked at the historical record for the last 10 years and saw that Lufthansa share price ranged between $6 and $30, and since 2017 has been on the decline and lower than that of its competitor and the industry average. The share price of United Airlines is the highest, with an average that is more than 3 times that of Lufthansa. Looking at the earnings per share, Lufthansa seems to have performed better than the industry average, but lower than United Airlines. However, coming out of the pandemic, its earnings has been better than that of its competitors. On the next slide, the P ratio of Lufthansa in the last 3 years, we observed that it compared favorably well with that of its competitors. Pre-pandemic, the ratios were in positive range, but during the pandemic, the ratios were all negative except the industry average. But even the industry average dropped significantly in 2021. This could be explained by the fact that Lufthansa carried out massive restructuring in order to overcome the impact of the pandemic. They suspended payment of dividend and focused on strengthening their balance sheet. On the next slide, we ask the question, can Lufthansa improve its PE ratio? Lufthansa can improve its PE ratio by increasing its earnings through a combination of increased sales from new product, new geographical markets, and cost controls, reducing its operational cost and accelerating the modernization of its fleet can help improve the company's performance. Innovative technologies that can improve the aerodynamics of their aircraft can also be helpful. Other factor which impact PE ratio is the economic conditions, but this is beyond Lufthansa's control. Economic growth and low inflation could expand PE ratio as funds flow into stock market in anticipation of strong earnings. Next slide, I'll hand over to Carlos to discuss our key learnings and conclusions.
Thank you, Ismael. Before analysis, we thought Lufthansa's diversified company portfolio would insulate them from the effects of the pandemic, but the ratios showed otherwise. Most ratios are trending positively, but Lufthansa is still in the recovery phase. Lufthansa has also received rebates from their government, aiding them to remain in the business during the crisis. An important key learning is that analysis of ratio should always be looked at in totality than focusing on 1 or 2 ratios. There is a need to go beyond the numbers. Read the report for explanations and insights. For opportunities, diversification of revenue, such as cargo, could cushion the impact of lower passenger traffic. Lufthansa can also look into streamlining and modernizing their fleet, do corporate restructuring to optimize the process, and improve the financial stability. Liquidity means access to more cash. It protects them from the risks, making the company more attractive to its stakeholders. Finally, use the pandemic as a case study to check the vulnerabilities and implement the initiatives to improve financial performance and associated costs. Our recommendation is that Lufthansa should put importance on profitability and liquidity ratios to support the company's recovery from the recent downturn. They should also analyze industry and competitors' ratio for a more data-driven decision-making. Thank you. We look forward to hearing your questions on our next session together.